Let me ask you something. What if I told you that a company can succeed or completely fail based on just one decision? Not the product, not the marketing, but something most people never even think about. How it raises money. Yeah, seriously. We are talking about debt and equity. One can make you incredibly rich, and the other can slowly destroy everything you built. And the way companies balance these two, that's called capital structure. So now the real question is, are they making the right choices or setting themselves up for disaster? Let's break it down, simply. Alright, so what is capital structure? In the simplest way possible. It's just how a company funds itself. That's it. Usually, it comes from two places. White right pointing backhand index borrowed money, which we call debt. White right pointing backhand index or money from owners and investors, which is equity. And every company has to make a decision. How much should we borrow? And how much ownership should we give away? Sounds simple, but this one decision can change everything. Let's make this real. Imagine you want to start your own business. You've got an idea, but you need money. So you have two choices. First option. You go to a bank and take a loan. Now you get the money. But there's pressure. You have to pay it back, with interest. No matter what happens. Even if your business struggles. Second option. You bring in an investor. They give you money. But now they own a piece of your business. No pressure to repay. But now you're not alone anymore. You share the profits. You share the control. And right here, this exact decision is what companies deal with every single day. That balance, that's capital structure. Now let's break it down quickly. Debt. It sounds risky, and it is. But it has power. You keep full ownership. You don't answer to investors. And in some cases, you even get tax benefits. But the downside? You must pay it back. No excuses. And if things go wrong, that pressure can crush a business. Equity. Safer, in many ways. No repayment pressure. No monthly obligations. But you give up control. You're sharing your success with others. So what's the smart move? Not choosing one, but balancing both. Too much debt. You're in danger. Too much equity. You're losing value. If this is actually making sense to you right now, drop a comment saying smart money. And if you like learning complex ideas in a simple way like this, hit subscribe, because the next video might completely change how you see money. Now here's why this really matters. In the real world, companies don't fail just because of bad products. They fail because of bad financial decisions. Too much debt. They can't survive tough times. Too much equity. They lose control and reduce their long-term gains. The smartest companies? They think long-term. They carefully choose when to borrow, when to raise investment, because every decision has consequences. That there's actually a term for the perfect balance. It's called optimal capital structure. Sounds complicated, but it's not. It just means finding that sweet spot where your costs are low, your risk is controlled, and your returns are high. Simple idea. Powerful impact. Here's where most people get it wrong. They think more debt means faster growth. And yeah, sometimes it does. But it also means more pressure, more risk, more chances to fail. Because if your income drops, even a little, that debt doesn't disappear. And that's how businesses collapse. So let's quickly wrap this up. Today you learned what capital structure really is, the difference between debt and equity, and why balance is everything. At the end of the day, it's not about how much money you have. It's about how smartly you use it. If you want to understand money on a deeper level and actually make smarter financial decisions, then don't stop here. Like this video, share it with someone who needs it, and subscribe. And tell me, what should I break down next?